So this is Ken Long with a review of the weekend trading report for January 31st, 2015. Market has moved into sideways volatile, yellow alert. On an annual basis, using weekly RSI 14, we're neutral at 58 out of 100. 10-day basis, using the 10-day NDX, we're oversold at 12 out of 100. You can see the price relative to the 200-day moving average is 1.76%. That puts us into sideways condition. The slope of the 50 went negative at minus 0.13. ADX is neutral at 19. The risk index is the 30-period moving average of the VIX divided by the 10. A reading of 1.0 is the boundary between risk on and risk off. That reads at 0.98 right now. So risk off is the reading. That means less risky assets are favored. Take that score of 0.98, compare it to the last 5,000 trading days, and compute the standard deviation to give us the risk Z of minus 0.31. You can see a 90-day histogram of that indicator. We're at minus 0.31 standard deviations below the long-term average, slightly improving. So even though we are volatile, the volatility is smoothing out a little bit. Suggesting, a sharp move north is possible here. We're going to see that we're in a critical state, so a sharp move in either direction is being indicated here. This is the blended monthly rebalancings. I either did that Friday or Monday, and those would be the holdings that you have in ETF 13, 22, and 32. It's still favoring the defensive plays. The theoretical exposure of the ETF2 model is at 40%. The model portfolio itself is at 60%. This is the blended monthly rebalancing. More than half are on a cash signal. That's price relative to their 4-month moving average. And it's the treasuries and real estate in charge. The 32 ETF portfolio, same thing, about 2/3 around a cash signal. And again, it's the fixed income and alternate classes like real estate are in play. ETF Max shows the top 50 based on about 1,200 ETFs. This is going to be dominated by biotechs and bonds. There's some India and China financials, retail holders. This international hedged equity fund is interesting because it's green and white. And then this one shows the top 40 or so of the S&P 500 through the same lens, including the sector of the S&P that they are a member of. Staples and Southwest Airlines continue to be interesting. Harman International is interesting, being green and white. Cooling off here in Ross Stores and in Celgene. Some new strength in Corning, being green and white. This is the market health check, the last 90 trading days or so. You can see we're in sideways volatile. The vertical blue lines are 10, 20, and 30 days of look back. This is the 60, and that's the 90. The horizontal purple line is the price target to the upside. We would need to see a close above 207 to pick up a long-term upward bias. Right now, we're still in the yellow zone here with price collapsing. In my view, if these two support levels here at 199-ish and 197 collapse, it gets us under the 200 period moving average. This support level here and this resistance level here get violated, and then it's look out below, and then I think the next test after that gets down to 89, 86, and 82 in a hurry. So that's the risk. You can see the real different nature of the last 30 days compared to the previous 30 in this nice long run up. This has been a market that is stuttering and faltering. It's been making lower highs as well. The dark blue shaded area is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. That's the Bollinger Band 30 plus or minus 2. The red ribbon through the middle is the dragon. That's the 10-period Bollinger Band plus or minus a half. You can see that the price has violated this for a third time with lower highs. The slope of the 30 is down. The slope of the 10 is down. The river is sideways, and we're below the dragon, and we're getting ready to dip into the 200. This is a negative market condition right here. Now, is it possible to find support here? Yes, it did. Well, like the last 3 times, and it was able to move up, but then not break through 207. And that's why I say this is, if we get support here, it's got to close above 207, then really above 210 to be compelling for the long side. On the other hand, these have been relatively constrained pullbacks, and we're at a support level where it's held the last 2 to 3 times. Now, that simply means that this is a critical state in which we can frame a favorable reward to risk ratio trade in either direction. And since we're in the yellow zone, I'm going to let the market decide for me what my intraday direction will be. I'm still cautiously optimistic here, but I'm definitely ready for the downside moves in my favored short side targets. The market has bounced from oversold to overbought, back to oversold. The jaws of PPO are open to the downside, and that suggests that a downward move is certainly in a swing trade frame time frame is certainly possible. And again, I would put that move with targets here in these red support lines at 193, 189, 186, and 182 for the downside. You can see how the slope of the 30-period regression line, this black line, has gotten back to the 0 line 4 times and then just failed, and it's now beginning to roll over to the downside. So that's where my downside concern is coming from. In the ETF2 regional report, 6 out of the 10 symbols are on cash signals, and so that puts us in a 40-60 invested versus cash relationship here. The S&P at 65 is better than EFA at 59, so it's still the U.S. better than the globals. The order of strength here in the U.S. is technology at 67, mid caps at 67, small caps at 66, and now the large caps are pulling up the rear at 65. 4 of the S&P sector spiders are on buy signals, and they are the relatively defensive plays of staples, utilities, healthcare, and discretionary. Energy continues to suffer, as are basic materials, financials, industrials, and technology. In the market health check, you can see all of the U.S. is above average. A handful of the European countries are now above average, but Austria, Spain, France, and UK all below. Canada, Brazil, Mexico, and Latin America itself well below average. Emerging markets are weak. Everything Asia is weak except for Hong Kong, Taiwan. India and Philippines are standing out, as is Thailand. The U.S. business sectors are defeating their global counterparts in every case except tech, where it's and materials, where it's a tie score. So the U.S. strength is still broad-based, and the dollar's up is still exceptionally strong, the broad-based dollar. Treasuries and U.S. real estate are dominating, as are all of the commodities now, gold, silver, bonds, equities, the special commodities, I should say, and oil and the base commodities are suffering in the red. So little to no change compared to the last couple months of trend. These are the ETF top 30. Based on the ETF2 lens, it's still the same ideas we saw in the BMR. That's biotechs, real estate, mid caps. We're seeing some gold creeping in, and some bond funds as well. The Dow 30, only 2 are on a red symbols. That's Chevron and Caterpillar. We have Boeing has moved to the top of the stack. It's green and white. That's very favorable for Boeing. United Tech is also favorable at green and white. And then losing strength, Travelers, Pfizer, DuPont, and Nike, the white and green, as is Procter & Gamble and Intel. Shifting to the daily report, we're just going to go straight to the tactical summary. A handful of channeling and overreactions, plenty of auto framer targets to choose from, and that's always going to be the case when you see the market itself is pulled back to the oversold condition. That's going to create lots of opportunities on the upside. So we might be interested in looking at the ones that are favorable on reward to risk and also outperformed on Friday. That'd be Caterpillar, ExxonMobil, especially looking good. Procter & Gamble and Intel, both good fraud candidates. And then we have a half a dozen that fired on the RSI too. So plenty of good candidates in the Dow. Good candidates also in the ETFs. There's 5 on the channeling, 3 on the overreaction, a 551W in silver. Brazil and the inverse VIX were crushed on Friday. Oil and the VIX were winners on Friday. USO with a 6.8% gain one day. And then a lot to choose from here on the auto framer, so that's all looking good. Auto framer stats for you and the RLFF framework. So we have plenty of good reward to risk ratio trades to frame and to choose from. And I'll cover those on the webinar on Sunday evening. So this is everything I wanted to talk about today. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.